And joining me on the podcast right now, and of course on video, if you want to see our facial expressions, the whites of our eyes in this dreadful, brutal market, it's Paul Hill, full-time investor, equity analyst. You're right, fella.
Well, almost, because obviously the markets have just been absolutely decimated of late, and I just saw given this is real time at 9:30 on Friday morning, and the FTSE is already down over 2.5% today. So AIM is another 2%, and the FTSE 250 2.4%. And I did actually have a look before we spoke that AIM is now down year to date more than 15% in small cap land, and wow, over 25% since its peak back in September. And I think that's something that you and I have been feeling that in our portfolios. I mean, how's yours been holding up recently?
Yeah, it's been, like I said, it's been dreadful for a long time. I mean, of course, when the industry is down by that much, individual stocks are down by a lot more. And so, because some stocks, will be rising. In fact, I just went through a list of 52-week lows on a website there, and there was pages of them. I looked at 52-week highs. There was like about 50 stocks, and there was hundreds and hundreds of 52-week lows. And so that's where we are. And the thing is, as we all know, unless it escalates to something that includes the entire world, then there's only sort of upside. I mean, of course, we're going to have a while of this, months and months. I mean, even now that fire in the nuclear power plant in Ukraine, when you think it can't get worse, you think, in fact, that could affect a lot of people. But that is the fear that people talk about, and more fear will come. That is the fear of buying into the market right now. I mean, if you're buying this company, still looking for good companies, but if you've got spare cash, right now, this is a big discount at many companies. Like, in fact, I punched on a chart of Boohoo yesterday, Guild Esports. I got, alerts on 52-week lows there, but they're way below that. I mean, 2016, August 26, 2016 is the last time Boohoo was at this price. Guild Esports IPO'd in October 2020, 8 pence, now 1.9 pence. That's the state of the market. But there's so much fear priced in, so much. And so I'm not saying plow all your money in now, but over the next few months, if things don't get worse, and I think both sides don't want it to get worse, really, even you've got a madman there in Russia, then, this is where the discount is. It's where you get the advantage above everyone else who's holding, who've got cash, who haven't got cash, who can't take advantage. That's where you outperform the market, because the market generally is either selling right now, or the private investors are, who's scared, or just holding. So it's a scary situation, but so the old Buffett saying, we all know that it's when the fear is high, you buy there, basically. But I mean, your portfolio is and mine probably like it's not pretty sight, but
I mean, it's a bit. I think you exactly got the words right. I mean, it's a bit like your shirt. It's the market's dreadful at the moment, and
hang on a sec. You were like Russia. You take the offensive here. This is as close as I can get the Ukrainian colours in my wardrobe. So I'll put that one on. Yeah.
I mean, we talked about last time in terms of when the small cap land will actually turn, and I actually think it's turning at the moment. It's trying to find a bottom. It goes into these type of cyclical downturns faster than the bigger caps, and it will come out faster as well. And I'm starting to see, I mean, my portfolio likewise has been mullered, as everybody else's has, but it's actually going down slower at the rate than it has done in the past. It's reaching a floor. I mean, you mentioned like Boohoo, it's been an awful, obviously, investment for me, but I'm happy to hold through it. And I actually think the sort of risk-reward profile is asymmetrically biased to the upside at the moment, because even so much panic, so much investors are panicking that they've just had lots of distress selling. I mean, you've got basically not only people who have hit margins and therefore been forced to sell, you've obviously got all those Russians and anybody who's invested in Russian assets who now can't sell, who are also getting sort of redemptions from their investors and then having to find, cash. And so they're just basically hitting the sell button just as an emergency. And then obviously on the other side of the coin, you've got very, very few buyers. There may not be that many people who are wanting to sell quality stocks, but I would say that there's very few buyers on the other side of the trade. So all you need is a small level of illiquidity, and you're getting that right across the patch, both in the bond market and in the equity market. And all that sort of like meaning is that we're just basically going down at the moment. And but I would say in the small cap land, and we saw this back in the great financial crisis, that I think we're going to turn fairly soon. And how is it going to turn? That's the key question. I think what the most logical solution is going to be Ukraine and Russia get together and have talks and agree and get their heads pushed together, agree that the country is going to be a neutralization zone by constitution. And you saw that after the Second World War with people like Austria, etc. So I think that's the working solution. And will Ukraine agree to it? Well, I actually think they're going to get. I mean, this is behind the scenes stuff, but I think the West will encourage strongly Ukraine to reach that kind of solution, and then hang out the carrot that they'll help them rebuild the country, put lots of investment into it to recover. And I think Russia, given that it's got all those sanctions and its economy is just, I mean, they've got interest rates at 20%. Inflation's going hyper because their currency's been totally bashed. And even though there's no sanctions on the gas and the oil at the moment, by hook or by crook, the traders aren't touching it with a barge pole. And I did see a stat that 2/3 of Russian oil and gas now is not being bought by traders anyway, because they're just refusing to hold anything that is remotely associated with the country. And on that basis, their power, their foreign currency has just been diminished. So I think they'll. I don't know, but I suspect that is the solution. And we could wake up one morning, even Monday, and this whole crisis has just de-escalated because both sides have reached a compromise on sort of like a country of it's going to be a country of neutrality, an area of neutrality. Whether it happens, I don't know, but I actually think a lot of this bad news is already into the price, and then we'll be back to the back to looking at the economy and inflation and stocks and shares, and on that basis, the sell-off is totally unjustified in quality stocks, which means as I say, I'm positive and I'm looking to redeploy cash. I don't know. I mean, you haven't got much cash to deploy, I don't think. I mean, even though you have splashed out on your shirt, but that didn't cost you much.
That was one of the best investments I've made. But
if that was your best one, I wouldn't like to see you worse, mate.
Do you know what? If you look at it in a real harsh way, I mean, the downside here risk is World War III. Doesn't matter what you hold then, everything's going to pot, so that's not likely to happen because the pain on either side now is very great. Like you say, Russian economy is in pain. I got to say, the oligarchs who put Putin in power, he turned the power around, he controlled them. They're now feeling a bit of pain, uncomfortable. The Russian economy, like you said, there are people now, 20% mortgages, the interest rate's gone up. They can't afford, the ruble's gone down by 50, 60%, and their mortgages have gone up. So the loans have gone up. They can't buy anything. So there's pain on both sides. So the route out of this, like you said, is some kind of agreement, and it makes more sense than just carrying on with the pain. So and I think that's the way forward.
The Russian banking sector has just gone bust. I mean, it's technically broke because it's not making international payments because it can't on the back of its dollar or foreign hard currency denominated loans. Spearbank, the largest one, is down to a penny. The stock is, which saying it's basically bust. And on that basis, you're going to get runs on the bank, aren't you? Through through all the Russians, they won't be able to get money out of the bank. So this could be the silver lining could be is that they reach a compromise and actually the electorate or the populace in Russia at the basically force Putin to stand back because they don't agree, and that could be a great way. We could actually look back at this and say, yes, it's a nightmare, and the humanitarian crisis has been a disaster. But actually, if you can remove somebody of Putin's sort of like notoriety, then that's actually at least there's a silver lining associated with it. But I think we'll wake up fairly soon. In the next 2 weeks, there'll be a compromise. They'll have a ceasefire, and the markets will rip. That's how I think it'll end.
Yeah. It's hard to know what's going on in Russia because you got different kind of the younger people on social media are getting a more fuller picture of what's going on. The state media are just saying it's a military operation. I saw videos of people being interviewed in Russia. They have no idea what's going on. And apparently they even don't believe videos coming from soldiers saying we're being killed and shot here. We're in a war here. They don't even believe in that, some of them. So Putin needs a win. and now he can win in his own country through state media because they're shutting down all other media. So he needs to get a win. He needs to get an out to this. Now, let me ask you a question about oil price, because of course the relief rally will happen. We'll have a bounce if we have any good news from this. We'll have a big rally. I think a massive influx of cash in the markets, and it'll bounce. But of course, then we got inflation. It'll help that as well. Of course, there's Iranian deals on the cards, isn't it, to bring oil to the market? But do you buy into the fact that we're going to have a recession? Because they've said lots of times when oil prices have spiked like this, there's been a recession afterwards. Do you reckon that's going to happen?
The yield curve flattening definitely suggests that there's a risk, there's a higher risk of recession. So I don't think this is going to be binary. In my view, it depends a lot on what the central banks do. If they decide to let the economy continue to run hot, which they did at the start of the pandemic, then there isn't going to be a recession. If alternatively, people like Jay Powell and the Bank of England decide to ratchet up interest rates in terms of, sort of trying to control and cool off the rampant inflation, which is going to be pretty elevated. I mean, I've heard that the UK inflation CPI is not going below 6% by the end of the year because of what's been happening in the energy markets and utility prices and stuff like that. But so if they actually do, want to cool off inflation and ramp up, the interest rate rises too aggressively, then yes, there will be a recession in my view. I think they'll take a more balanced view, and they'll let nominal inflation carry on for a longer period. And if that's the case, then you don't want to be in bonds basically, and you don't want to be in cash. And we won't get a recession. But if they take the other side of the coin and go super hawkish, then yeah, I think it's inevitable we're going to get a recession to a certain extent, because you can't have all the levers being sort of like pushed at the same time. But I don't think that will happen. I think the base case has got to be we're going to avoid it. And on that basis, I think the line of sight for somebody like me, who's a long-term investor and got a more positive outlook, is to buy on the sound of cannons, and what's been happening in Ukraine and Russia is to look for opportunities to buy good quality firms in my sort of like areas that I'm looking for, which is tech, software, and healthcare.
Yeah, and people shouldn't worry too much about the recession, Wood. I mean, it's literally 2 quarters of contracted GDP growth, and that's a backward-looking indicator. And the markets look forward, So generally, when you have that, like I said, microcap stocks are coming out anyway. They're rallying, so they've got that's priced in. It's already people can see recession is coming pretty much a little bit, can't they? So the indicators are backwards looking, so people shouldn't worry about it. They say, that's the trouble. So you see these things, these terminology, bear market, recessions, and it comes down to you can't control any of that. And at all you can control is your exposure to the companies you have. Now, look at the companies you have and thinking, okay, they're going to be in a better place in like 12 months' time, 2 years' time, 3 years' time. If they're growing, they're improving, they're good value at the moment, then hold on to them. There's nothing to check it, because otherwise, what do? Sell on any big macro worry. And then where do you draw the line? And what's the big macro worry? So all you can do, like I said, is focus on your own companies, isn't it? And look at their results coming out. Are they performing as they expect? If they are, carry on. If not, it's a trouble. People get worried, they sell. The market makers move everything down because of bad news. People sell because the market makers move something down, and it's self-fueling. It'll just carry on. And you think, how do you break the cycle? Stop selling good businesses. That's what you do. Yeah. Stop selling. I know.
Yeah, well, just finishing up on that one. I mean, Equals, for instance, the company that I own, I think in all this turbulence with the volatility in the Forex markets will actually be doing really well. And the shares have dropped sort of like almost 25% since its high recently, it's sort of like a month ago. And when you look at that, you just think that's just frankly nuts. But those are the kind of opportunities that people should have a look at, is that where you get really good, fast growing, high operational gearing businesses in really nice areas, and they're doing a great job, drop because just there's some sellers out there. So you look at that, it's perfect opportunity to to pick up. And I do eat my own cooking, there's no doubt about it. And guess what?
Yeah.
Guess what, Justin?
What?
I have a new purchase because
Okay,
you know, basically,
well, before you drum a bit of bit of drama here. Before you say that, did you see that announcement by Trufin and Equals and all that stuff? I don't know if you saw that on.
yeah,
on
I saw it
LinkedIn.
through Twitter through you actually, mate.
Yeah. It was quite good little thing because Satago, of course, is one part of Trufin's holdings. They got 4 holdings: fintech company, it's invoice financing, all that stuff, and effects. But they've hooked up. They've launched their ecosystem, and I'm trying to find it. But in this ecosystem, they've partnered with Equals, Western Union, big company, TransferWise, now called Wise, another big company in their accounting side, with Sage as well. Of course, these are big companies that you've hold. So yeah, so it's very good to see these hooking up, and of course, Trufin in the background with Stargo, they've got the Lloyd's deal going on. That's due out early this year. So I think that when you've got companies like, quality companies from Equals, Western Union, Sage, Wise and Lloyd's, you can sort of tell then by validation there that that's a quality bit of software. Otherwise these companies wouldn't be involved with it, so I like it. And of course, Equals is a quality company. And so we're joined at the hip now, Paul, in a certain way.
Yeah, no, absolutely. And my acquisition, not acquisition, my first sort of like, I've been talking for 2 or 3 months. I want to deploy money into the sort of tech and software.
Come on, what is it? Drum roll.
It's the old First Derivatives business. It's FD Technologies, which has basically come down from about sort of 30, 40 pounds over the last year or so. And it's trading at about 15, 16 quid. And it's
what's the ticker there? What's the ticker?
FDP. It's a roughly market cap is, I think it's about what is it, 400 460 million, something like that at current levels. It's best in its class at what it does in terms of it's a big data analytics and fintech software and services firm that its real USP, it can process like zillions amounts of real-time data and bring out real actionable insights from that. And it's been doing that for 20 odd years in the finance area, largely for high frequency traders, hedge funds, algorithmic traders and stuff like that. And it works with all the sort of the major merchant banks and hedge funds around the world. So it's got brilliant sort of like, credentials and vertical market expertise, but it's a sum of the parts story. And it's got 3 divisions. The jewel in the crown, which is what really interests me, is this KX Insights business, which is a pure software business that does the clever analytics, real-time data handling, AI, and big data analysis. And as I say, it's born out of the sort of the finance area, but is now expanding into other verticals like, preventative maintenance in factories, into healthcare, into the energy sector, sort of like, the IoT, Internet of Things, looking at sort of like smart meters and stuff like that. And it's got, a huge sort of new addressable market that it can do. And it recently just signed a deal, a flagship deal with Microsoft Azure this week, where it's going to basically, Microsoft is using it for its cloud, big data, real-time analytics systems. So that was a great partnership, and another one, a great endorsement of the actual technology. And what it's happening is that it's transitioned now to almost like 100% SaaS business. It was more perpetual license, and that's depressed the revenues from the division this year. But frankly, it's growing and is targeting growth of ARR around about 25%. And that transition should largely be done and dusted by the end of this financial year, which I think is March 2020. And on this basis, I would conservatively value this at sort of like that division at sort of 5 times sales, which if you do it is roughly sort of like 375 million pounds. So that's the first division, the jewel in the crown. The base business, which is what they sort of was born and bred 20 years ago, is the old First Derivatives, and that's a sort of technology-led fintech services type of business. And what it does, it basically helps digitize and do all of the IT and software implementations for all the major banks around the world. And we know these guys are really struggling with their legacy systems. I mean, I know it from HSBC, but Lloyd's and and all the US ones. Like, I mean, we've had huge investment, NatWest as well. And you've had huge investments from Citibank and from JP Morgan and all the others, basically saying we need to significantly increase the level of software and IT capability within our business, just to keep competitive against these fintech guys. So this has got again a massive addressable market, and it's stuff that the banks and the old legacy companies, which is to say it's a $200 billion market, can't avoid if they're going to stay in business. And these guys service that. And I would say that one's worth about 200 million on its own, about 15 times EBITDA. And then the third and final division is called MRP, which is basically a vertical market application of the KX Insights business into the sort of the marketing and advertising. And it helps these business leaders, the sort of chief marketing officers, make better decisions when it comes to how they deploy their promotional and marketing spend. And that's a software and services because it's based on the old KX business, and it has sort of the analytics and AI on top of it. And I would say that's a sort of, £100 million, 14 times EBITDA business. They have zero debt, zero cash, which is, net is effectively, break even at the moment so the balance sheet is absolutely fine. You put all that together, you get 640 million. And I get a very conservative valuation of £24 per share. Peel Hunt, the house broker, have got £27 just over per share, and Investec have got £41 per share as a valuation. So I think there's plenty of upside here, and it's a fallen angel to a certain extent. And I think these, I bought it basically because I think there's significant upside. It's got great growth credentials. And on a sum of the parts business, I wouldn't be surprised if somebody bought them out over the next 2 or 3 years because, it looks in a very good space, and the growth is very much assured in my view. So, that's my latest fintech software and services business in high technology area. It should be growing overall. If you look at the blend, it should be growing low double digits top line, for a long period, and increasing its its operating leverage because more and more come from ARR from the KX Insights business. So, margins are only going to expand.
Yeah, that's. I'm looking at the chart there. It's a volatile chart, isn't it? It's like I'm going to look back 2000.
What isn't? What isn't?
I know, but 2018 there, right? It was at 48 quid a share.
Yeah.
I don't know what happened there, but then it dropped in October 2018. It dropped off a cliff from like 40 quid, it nearly halved to 24 quid. It's gone up and down, but again, it's gone up and down, but it's been in a downtrend, but rallied strongly, big range and rallied strongly. But so that news recently did pop up nicely on the couple of days back. Or was that you buying?
That was me buying. No, it was basically the Microsoft news. It was the Microsoft news. Yeah. Okay. But I mean, there's plenty of value there in my view, as long as you've got a 3 to 5 year view, and I'll hold that one. It's a full position. And it's my sort of first real sort of like purchase. But the key, I've said many a time, you don't buy everything you like. You buy stuff that gives you what you want in terms of your portfolio construction. This was just perfect, right into software and services. It's pretty much an assured growth story, some of the parts, and it's got lots of potential upside. And again, when we come back to sort of like buy on the sound of cannons, when there's panic in the streets, etc. I think not only you could get potential resolution, how it could end. I think there'll be lots of M&A now because I think, overseas buyers or just people, private equity have still got quite a lot of big cash and they see these bargains, particularly in software and services and healthcare, and they're going to pick these companies up. That's what happened at the great financial crisis. It happened, they didn't have much time to respond during, sort of like the pandemic phase one. But there's going to be money to deploy, and you'll see M&A significantly pick up. And this is another classic sort of M&A target in my view.
Yeah. And where are they? Are they making money? I mean, at the moment or not? Yeah,
they're spending a lot of on their main divisions, which is should we say their first derivatives, is definitely it's profitable. MRP is definitely profitable, but I think it depends on how you actually do the accounting for sort of goodwill, R&D development, etc. for the KX business insights business. But for that sort of like platform, you don't want to be scrimping and scraping and nickel and diming to stop the growth, So they're investing heavily both in the product and in entering new markets. So expect sort of like that best to break even for a year or so. But if they can knock out 25% per annum ARR growth, this is just adding underlying value to the business, because the profitability and cash generation will come through later, and they don't need to be generating shed loads of cash simply because they've got a good balance sheet anyway.
Yeah. Well, shall I tell you what I've bought?
Yeah, what did you buy?
It's completely different to that. It's probably the smallest market cap in my portfolio. I just think at the moment, footfall is going to increase, okay, slowly but gradually. It's probably not going to get back to where we were. But I had a chat with Space and People, the people from...
yeah.
It's a tiny little... basically, they lease all the spaces around shopping centres, in shopping centres, and then they obviously contract that out to people. It's for brands, promotions, all that stuff. But I just look at them, and they took a C-bills loan out. They've got about cash headroom, plenty of cash headroom, a couple of mil. They're like 3.6 million market cap. But I looked at 2019. Right now, they've changed. There's a new CEO who was co-founder, but she's a new CEO. She's changed the business around. They've cut costs. They've now got £1 million of annualized costs they've done there. They've also got more venues. They're based in UK and Germany. They did have India, but that wasn't a good plan for them. And part of the new CEO's role was cut costs like that. And so now they've got an extended portfolio. They're cutting $1 million of costs a year. I mean, even in 2019, they turned over 7.7 million. And they were profitable, operating level, 100,000. Now, like I said, bigger portfolio, costs are lower, and they said there's more chance to expand. So I've just gone into those. I think we'll have a slowly. I've been looking at footfall across. They just extended their contract with Network Rail because they're in all the big railway stations as well. So any of these big promotions you see at railway stations, the big footfall ones, that's through them basically. And so I just like it. I just think the valuations are this year. For example, they did a trading update, and of course, their COVID hit massively. They did a trading update. Now, the first half of the year for 2021, which pretty much they were shut until the end of April, they did 1.1 million in sales. The second part of the year, they did 3.4 million. So they're saying this year they do 4.5 million in sales. That's around about if you look at the second half, they're doing about 500,000 in revenue a year. That's going to build. I think they'll be back to 2019 levels this year, and they'll be profitable because their cost base is greatly reduced and their portfolio is more efficient. They've renegotiated terms of agreement. So, yeah, and even in Germany, apparently the deals done over there with the big ECE, which is the big retail group or property landlord, is very favorable. They don't need hardly any money to make a profit. So I think it's done in a structured deal where they don't have to pay anything out until they get clients in. So, yeah, I quite like it. So,
and what's I want to ask you, what do you value it at? How much is the shares currently?
Well, if you look at even one-time sales, right, and they're profitable, that's a double from here. So right. I'm thinking.
So what are they currently trading at?
They are literally 2.6 million market cap. Their EV is about 3.5 because they have got C-bills loans there. But I had a meeting with the management, and I said, and obviously they can't say too much. But I said,
what's the ticker?
SAL. I said, will you need to raise any more funds? They said no. So I said, you draw from conclusions from that what you want. So, and he said, they saw my video, did a video on it. He said, your video is quite accurate on where we think we are. So I'm quite optimistic they'll get towards 7 million in revenue this year, which is pretty much double. They're more than double their market cap, and they'll be profitable, or close to profitable, if not break even. So, and like I said, they've had an efficiency drive on. So I'm thinking maybe a nice little play. I'm aware I'm in two sectors now, a retail kind of thing and leisure, which is XP Factory and this. But I think barring World War III, I'm just thinking it's a recovery play over the next couple of years. In fact, there are loads. Recently we went through on the Sharepickers Investment Club. We went through this and other stocks. We looked at Jules, we did Purple Bricks, but we also looked at Boohoo and all that. Things like Jules as well. Nuts, really, the valuation there. And there's lots of companies out there in the retail sector where you think even if you just get back to 2019 levels or round about that, it's some great upside in some of these
Yeah.
companies. That's Babu as well, all that.
No, I know.
So
Yeah.
that's what I'm hoping for. Just get back to 2019, but now they've had better margins and they've got a bigger portfolio. So I think they'll get beyond that maybe next year. But this year, hopefully they'll do that. But yeah,
What have you sold to buy it?
I've moved stocks around from all parts of my. In fact, all I could do, because there's not a lot of liquidity around, I'm just taking top slice quite a few of the stocks I have just to put into that. So I've not reduced massively on anything, but I've just I've not for a while. I mean, this is a few weeks back, but I mean, I'm not selling anything in this market now. I haven't made any trades for like a couple of weeks now.
Other than this one, and is it a full position? Is it?
Not really. I mean, it's a tiny market cap. I own 6% of the company, but that's
you own 6%, do you?
Yeah. But that's because it's a tiny company, So it's
you're
not,
right.
But and that's. I mean, the reason why I do that as well is I can't get out of this company, but I have to have a high conviction, rate of a good return. Otherwise, it's going to go south on me. But that's why I think, well, they don't have to achieve too much, even 1-ton sales, and they're going to be close to profitable. That's not a big ask,
Yeah.
So who knows? Barring any future, crazy Omicron variants or COVID variants, I think retail will go back to sort of normalish levels. They might not get back to where they were, but they don't need to be back to where they were,
Yeah.
So yeah. Anyway, let's look at the other stocks. What are you looking at?
Well, I mean, basically, I had a Polarian Imaging take. It was sort of like moment. Last week or this week, it was basically Amryt Pharma. They got one of those horrible complete response letters from the FDA for their oleo gel.
FDA, man.
I know, yeah. So the shares have been knocked, which is strange again because the phase 3 trials were positive. They met their primary end goal, and that says to me one of two things. It was either what they requested from the FDA was too broad, and it may have not been just the severe EB condition they were actually treating. It may have also been looking at sort of like more milder conditions that potential may benefit, and it's sort of like just wait and see what the FDA say. Anyway, they said they want more information in terms of the efficacy, which says to me, for all intents and purposes, that as a worst case, the oleo gel is not sufficiently effective. The efficiency isn't sufficient to be able to get FDA approval, and if that's, even though it does met its primary, its end goal, and on that basis, then you've got to look at the rest of the portfolio. And I bought Amryt Pharma based on the rest of the portfolio, and you got oleo gel for free. So the shares have been sold off simply because lots of investors bought into the oleo gel story, and basically have offloaded their positions. But I'm happy to hold. They've got the prelims coming out next week. The shares are looking at pretty low, pretty sick. I've lost about half my value on it. It was a big investment, but I definitely don't think it's the end of the story because they've got good franchises. The MyCapsa acquisition they make, we'll wait and see what their update is next week. They've refinanced. They've got plenty of cash available. It's obviously a big, disappointment, and you never know. These things can turn. If there's any positive news on the oleo gel, it'll do very well, and that may come this week. This month. I don't believe it will because the European Medical, Authority is also sort of like doing its final assessment on the oleo gel. I personally think it will probably take the same view as the FDA and not approve it, but we'll wait and see. I mean, I don't hold my breath for it. I've written the oleo gel product off in my own mind because I never bought it. I never bought Amryt Pharma anyway because of it. I did it because of its other portfolio and what it was doing. But it's clearly a big disappointment, and it's been hugely negative for the shares. So we'll wait and see. But it's that classic sort of thing. When you're in it was a £600-700 million business dollar business, and when you're in that type of basis, you're still in big in sort of healthcare terms very small, and you're dependent on what happened through your pipeline, your drug pipeline, and like Polarian Imaging, it got a knockback from the FDA. And I mean, my view is that, say, when you get a complete response letter, your technology is not sufficiently innovative to be able to get approvals, but that doesn't mean it isn't for Polarian. It just means that it's the case for
yeah, it was funny. I've been speaking to Vadim Alexander, head of healthcare at SPA, and one of the brokers there, and he's saying there's a lot of these happening, complete response letters, and it's more down to just the sheer volume of work the FDA have. And if there's any questions or queries on any documentation or submissions, they'll just knock it. They haven't got time to go back and forth with the company. And so you've seen loads of them. Let me ask you a question. Do you change? Because one of the things I've done previously is I've done 10 lessons I've learned from investing in the stock market. And when you make a mistake, when I make a mistake, I take a big hit on a company, I try to learn something from it. That way you hopefully get better in the future. Now, what I learned from Polarian is, even though the brokers are saying it's a 90% chance of approval, I'm going to ignore that in future, because you never know what's going to happen with an outside body like the FDA, where you rely on regulatory approval to gain commerciality. So in my view now, I'll avoid that binary outcome. I will not invest in a company which is reliant on an outside group, it's a regulatory body, to give them I'll wait until they've got it or not. Share price may rally if they get it. There's always opportunities where share price comes down. Like, for example, if Polarian got the FDA approval, I guarantee the share price would come down in this Ukrainian war thing anyway. So there's always opportunity there. So I prefer to, avoid that risk and then buy in when you have a bit more transparency and visibility about what's going to happen future-wise. Do you take those things on board? Do you think,
I went into it fully eyes open, so I knew what the score was in terms of, these things aren't 100%. I mean, let's be clear about it. Equity, when you buy shares, it's risk capital.
But that risk is known, isn't it? I knew that risk. I'm stupid of me. Yeah. I knew that risk there, but I didn't. I bought the shares at 14, 15 pence. So in that big down day, but I did average up a little bit. So that big down day, we went down 60% playing. At one point, I went into the red. It bounced back up, and I took some off. And I thought I should have de-risked before that, because that was a known risk. Regardless of what the brokers say, it was a known risk I could have avoided. There's the ones you can't avoid, unknown risks, of course, but a known risk you can avoid,
Yeah, but I mean, when you got sort of known risks, you have to look at the ups and downside, don't you? And if the risk isn't priced into the shares and it's overvalued, then I'd agree with it. But if essentially, if you still think, regardless of the risk, that the company's worth more, even if it comes out with a blank, than the sum of the parts, then the risk is, in the long term for investors. You've got to, nobody's perfect, and I'm certainly not. There's no doubt about it. I mean, say my hit rate is only sort of like, 2 in every 3. So, one goes south, and that's part and parcel. You've just got to accept that some things go against you. You can't control the outside world. All you can do is assess risk, assess probabilities, and compare it to your long-term time horizons, what you're looking for, your financial objectives, and what your risk tolerance is. And if you do that, then you've got a decent chance of making money, and you can sleep reasonably well at night. Yes, it was a painful, and that when it comes down, but that happens. I mean, it's like boo-hoo, I mean, I still can't believe it's trading at 70p this morning, but it is, and that's the way it is.
Yeah. No, I suppose it's a little bit different. I'm talking about, for example, Buffett talks about invest in boring stocks that you can shut the market down tomorrow and they'll still be trading fine in 5 years' time. That you have visibility going forward. Like I said, how many people are going to stop drinking Coca-Cola? That's his thought. How many people are going to stop buying Apple products? So it's that kind of predictability of the business, where when you go for FDA approvals, it's very high risk, isn't it? Where you can avoid that. You don't need to.
Look, mate, you've just invested in space and people. I mean, that is high. That is high risk. That is, when you think about it, that's a lot less risk than say going for an FDA approval, especially when that counts towards an entire commercialization or a majority of it. That's completely. They've got revenue. They're going to be profitable. They're very lowly valued. Whereas, for Polarian, they're valued at 150 million, very little revenue. FDA, who knows what's going on in the FDA? Who knows? That's the black box there.
it's like, at least I sort of know there's going to be a high footfall through retail areas, barring some COVID variant, which I don't know. That's funny how that's disappeared all of a sudden. But no, what I'm saying is you can predict that. FDA, you can't predict that at all. It's a black box event. You can't predict.
Yeah, but it's nothing like Coca-Cola or P&G or.
No, I know. But what I'm saying is, would you be happy again to invest in a company where it's going towards FDA approval, thinking that's fine? Because I wouldn't. That's what I'm saying. That's why
you have to take it by case per case, and if you go into healthcare, that's what you get. I mean, let's be clear about it. The healthcare companies live and die by the expertise they have in specific, medical therapeutic areas. And that's when they bring drugs to market, that's what happens. You get basically blanks. And, if you either avoid healthcare, that's great. Or alternatively, you decide to invest it. And if you decide to invest
what I'm saying is, I'm not saying avoid it. There's not that. You have another option. You don't say stay in or stay out. You've got the option of saying, why don't I just wait to see if they get FDA approval? Because if they're going to be chucking
because you're always going to wait. You're always going to wait. There's lots of.
No, but that one there you had. I mean, how many FDA approvals? How many knockbacks have they had from the FDA?
But this is the second one they've had. Basically, they had the one in. But I mean, I think it comes down to personal risk tolerance. You are saying that for you personally, you wouldn't do it. All I'm saying is that I take it by a case per case basis. So you've got to, and how you want to view it. And yes, this could have easily been approved, but it didn't. And you just got to accept that that's the case. And would it change your behavior? I mean, I've owned. AstraZeneca's done really well, and it gets FDA approval and approvals across Europe and China every single day. But that's what happens.
Again, but hang on a second. No, you can't put FDA and Amryt Pharma and AstraZeneca in the same box because AstraZeneca are chucking out loads of cash on other commercial products already. That. What I'm saying is, would you not do anything different again? Because I would before the FDA approval, or before would you not do anything different?
I don't think if you accept that risk and you're looking to invest in healthcare and you knew your eyes were open going forward, I don't think that it's not an impossible outcome. It was always a chance that this was going to happen, and I accepted the risk. Yeah, I don't think. Do I wish I hadn't just lost 50% of my investment in Amryt Pharma? Of course, I wish I didn't do that. But that doesn't mean in 3 or 5 years' time that the shares aren't going to be a good investment. I've seen this plenty of time before. You look at Northbridge, you look at EQLS, you look at sort of Alicosoft, where I've bought it, and you bought them, held them for years.
No, but hang on, they're very different companies. With those guys, they are, like I said, they've got a predictable revenue stream. They're not going for a binary outcome, which is based on a regulatory body.
I think what you're trying to find. You're trying.
Listen, to... No, there's one. I'm trying. I'm doing it. I'm learning from. So I'm saying,
no. For you,
for me. But I'm saying, if I want reward, but I'm in microcap spaces, okay, which are very risky in themselves, I have to eliminate all the known risks I can, but they've got to have potential to grow as well. So they've got growth, value. They have cash. But are there risks out there? Big risks I can avoid. Yes, there are. That's why I avoid oil and gas. That's why I avoid clinical trials companies. All that, because they're odds against. And there's no point. That's gambling odds, but you can manipulate the odds in investing to odds on. And FDA approvals, to my mind, brings that towards odds against rather than odds on, because it's all about probability. Investing is gambling.
Yes,
Life is about probability. Yeah.
Agreed.
So I'm saying, if you're not prepared, so I'm trying every time I make a mistake, I'm trying to say, okay, next time, how can I learn from that to manipulate the odds in my favor better than that situation there? And to me, I'll wait for FDA approval to pass. I don't care if it rallies 100%. If I like the company, it'll come back, So, yeah.
But all I would say is that works, that principle works for you now, okay? Yeah. But don't overlay it to everyone else as a doctrine, because that's a one size fits all, and it all depends on personal.
I'm not saying it's a doctrine. I'm just saying that's what I do. That's what I've learned.
But I wouldn't. So I take it on a case by case. I'm perhaps more broad shouldered when it comes to sort of like that type of stuff. And if I go into it eyes open, I know what the downsides are. Then there's always downsides for everything, and it's a known risk. And that's what happens. I can't, as I say, have I done well on Purple Bricks? No. Have I done well on Boohoo? No. Have I done well on Rosslyn Data? No. They've all gone down, yeah. And those were, that's what happens. And you just got to accept that you're never going to be perfect. but if you,
Yeah,
but if personally,
no, perfect.
let's move on. Let's move on from this. We've killed it to death.
No, I know, but no one's ever going to be perfect, but we can get better, you know. And that's to say, mistakes are lessons, you know. And sometimes we say, okay, what did I do wrong there? What did I mistake me? And just that, I'm not talking about massive changes, just little sort of, you know, just little changes there, you know, incremental changes. We can say, okay, maybe I should have done that. Maybe
I think the mistake. I actually think the mistake with Amryt Pharma would be to sell now. You'd be nuts to.
Oh yeah, of course.
Because essentially it's already oversold. And
I see people now worrying about microcaps AIM stocks and get out of AIM stocks and going to bigger energy companies. Are you what you essentially doing here is selling at the bottom and buying at the top, because these energy companies are rallied. They've rallied. It's too late for that. You know, they may have a couple of years, a couple of months left in them, but the big moves being made in those companies that are churning out cash through energy, and so people are jumping out at the low. That's, of course, is a mistake. Of course.
Yeah. No,
anyway, any other companies talk about?
Yeah, well, I mean, you had big news from Verici today. They've just basically proposed to raise £10 million. So, and you've got anchor investors, Christopher Mills from Harwood, who's all over life sciences. He owns 20% of the stock. He's invested. It's at 35p, so it's a pretty low valuation. Plenty of upside in my view. I think they'll close the fundraise, because most of them do when they're announced, you know, probably tonight, and we'll get the final how many people have actually decided to invest. But I think they'll get the full sums. And what I believe is that because they're coming up to, you know, they said at the end of Q1 they were hoping to get final data on their validation study for their sort of 2 flagship diagnostics for or tests for the kidney transplants. Then I think that's going to be positive. It's a good sign, because they wouldn't be raising money, and they don't desperately need to. What they're raising it for is to accelerate the commercialization of their existing products, and also to invest in their capability, their testing, to be able to run these tests, which says to me they think the current level of assurance on the study is good. And also they want to invest in another new product and service, which is leveraging all the data and the expertise they have in house from that biobank, from the RNA data, the immuno profiling, into other verticals for themselves and for other third parties. So it looks like a good bullish, you know, sort of like fundraise to me. And
well, I often say to people, you know, when you've got companies, they're, you know, one of the things, the biggest things a pre-revenue company risks, of course, is having cash. And I say, if you like a company and you're not sure about it, you know, after they've raised cash, it's quite a safe time. You may have a bit of churn in the stock afterwards, but it's a very good time, safe time, because then they've got a long runway of news and they've got plenty of cash. That's a worry removed, isn't it? Because that's one of the biggest worries for companies. But once they access that cash, it's fine. Anything else? Anything?
Well, you got TRLS basically, who announced that it was now launching its direct to consumer proposition across, starting with 3 states, New York and a couple of others, Connecticut, etc., and going to roll that out to another 17 by the end of the year. And that just makes perfect sense to a certain extent, because it gives them more volume. It allows them to stress test their telemedicine system. And, you know, that's all in sort of Crohn's and colitis and IBD. You know, sort of like get closer to the day of sort of commercialization. It'll make sort of sales. I think we had Singer Capital Markets forecasting just $3 million of sales this year, but going up to that, the pivot year is next year, is when they hit 18, and they've got a conservative target price of I think it's 47.5p. So, you know, there's plenty of upside on both those, but good quality companies in healthcare that are obviously early stage and are pioneering in this sector, but they've come down a lot, and you know, they look like good. If you want healthcare, then, you know, they're a good place to be. They don't need FDA approval of, obviously, either of them, and as long as the product works, and it says to me, certainly, you know, both do, because they're signing the contracts, then, you know, that it just is a matter of being patient, going through the volatility. Definitely don't sell, and if you haven't got it, then consider to buy. You know, they're the kind of things. And I mean, another one in the healthcare sector was, you know, Oncimmune, and it came out with interims. And yes, the headline numbers for the first half was soft, simply because Q1 they got, you know, a lot of their customers went on holiday and therefore were out the office, and on that basis, it's been Q2 onwards that they've really started ramping up. And this, just to remind investors, they basically do this lead Immuno Insights business that has got eight or 9,000 sort of protein biobank for auto antibodies, and they sell that sort of proprietary data to massive big pharma, and they just announced another contract as well with one of the big top 10 pharmas today to commercialize the Seratag drug discovery platform. So you use it right across the sort of spectrum for the large healthcare. And as I say, once you get those endorsements from many of the large companies, Genentech, Roche, and these kind of guys, it just says that they can't go anywhere else for this type of insight. And it's a really valuable database.
Again, you mentioned best in class a lot. And when you see, like you say, when you see these big multinationals using Oncimmune's products, then you think, well, that says everything, doesn't it?
Yeah, and they should have a monster second half, because I mean they did about $1 million of turnover Immuno Insights just over in the first half, but he got the CEO Adam Hill guided towards $6 million for the year, which means $5 million for the second half roughly. So it's going to be a monster increase, and that really launches them into the following year. So yeah, I mean they're signing contracts left, right, and centre, and they also signed another one with one of the Google subsidiaries to do again to access their big data, and I think it was in long COVID. So they've got so many fabulous names who want to get into this space to use their Immuno Insights business that they do. And when I interviewed him earlier in the week, I said to him right at the end, what's the news flow? He said contracts, and that's what they're going to do. That's what they need. That's what they're doing there. They've invested in their testing capability in Dortmund. They've scaled that. They've got the sales heads in the US where they're signing most of the the deals, etc. And they've
I like the sound of Oncimmune. I mean. And I hope they haven't got any FDA approvals coming up, do they?
No, they don't have any FDA approvals. It's their partners and their customers who do the FDA.
Good.
So
let me mention one of my stocks, by the way. Getech, I don't know if you noticed this. Well, so there's news on Space and People extending the contract Network Rail, but also Getech, which is they've just announced contracts worth 1.2 million. I quite like this because they're across both sectors, energy basically. Their traditional customers are oil and gas because they use their software, their data to locate and de-risk and optimize sort of subservice contracts, oil and gas. So in that area, and of course, those companies now are chucking out big chunks of profits because of the oil and gas prices very high, but they're also into hydrogen and with SGN and all that. So they got both sides of that. But the share price, they're taking a bit of a knock. Like I said, at the moment, they're 18 million market cap. They've got about 6 million in cash. So, so I quite like that. Yeah. So they are across the energy transition, which is massive, of course. We sort of become aware of how much we rely on energy when we have situations that's happening in Ukraine. But but again, I think this year they'll start rolling out more contracts on hydrogen. And in fact, I was thinking, when you get rising ONG prices there, it's quite beneficial to renewables because it makes them less expensive by comparison. ONG companies, for example, make more profits and they have to diversify away. So this, like BP and Shell are spending more now on renewables. And also governments in situations like this, when they realize they're reliant on oil and gas from countries, rogue states like Russia, they're going to have to start diversifying their own energy policies, which I think is quite bullish.
Oh yeah, clean energy is going to get huge excitement. I mean, it already has, but it's going to get continued massive investment by states and by corporates to accelerate that whole transitions. Yeah, so I'm totally with you. I think it's good. It should be a good place to be.
Yeah, cool. Anything else, fella?
Yeah. I mean, basically, with Revolution Beauty, and I've talked about this. Does quality affordable cosmetics? It's expanding rapidly out into the States. I think it's one of its largest markets now. Actually, anyway, it bought a company out of receivership, BH Cosmetics, which stands for Badass with Heart, and that's a sort of iconic brand. But because it bought it out of receivership, it got it for sort of like less than $4 million. And just to let you know, I mean, this business in 2019 did over $55 million of turnover. So there's plenty of upside. It looks like a deal of the century for them. So they've got a really good iconic brand with loyal customer bases that has went through the pandemic and got hit and couldn't get out of it. And they bought it for a dime, basically. They'll use that. They'll use it. They'll get synergies basically by obviously the scale through product development, etc. The BH Cosmetics will help them further extend their coverage into the US, and obviously Revolution Beauty will help BH Cosmetics extend its global footprint across the rest of the world. So it looks a great deal. When you can get those type of choice assets from distressed sellers at less than sort of like what is it? It's less than was about 9% of pre-COVID revenues. I mean, you're onto the deal of the century there. So that looks really good.
Yeah. I'm looking around and realize, like I say, barring World War III, there's a lot of upside, massive upside.
Yeah, there's massive. I mean, you just got to stick with it, and no doubt about it. And then the final one was when I know we did 2 weeks ago, we did breaking news, didn't we, with Northbridge? And I just wanted to finish up on that one from their sort of trading update. They've got a capital markets day, I think, coming up fairly soon in March. I think it was the 10th or something. But we talked about it, that the Creschick business is absolutely flying at the moment, which it obviously is, and they've just sold their Tasman business out in Australasia, so that means they're going to be net cash, and they can now start buying back their own shares as well because they've got surplus cash, and that's just a great situation to be. And then even better, they've got Christopher Mills' son Nicholas on the board, who's a super smart investor. And I mean, I've done one thing I hadn't done when we spoke was actually to recut the numbers and to look at the valuation. And I've increased my valuation from just over £2 to 244p. And that's basically gain on a modest sort of like, EBITDA multiple. And the big thing that, investors should think about it is that when you've got a load bank, because it's electric or heat orientated, there's no moving parts. These things don't wear out. And therefore the actual value of a load bank, particularly Creschick's ones, if anything, increase going forward. They don't decrease. So what you should do is that, most of the analysts out there, put in this, adjust for obviously this depreciation charge, put that into comparative estimates and compare it to sort of like other plant hire firms, specialist rental companies, and they use this sort of sort of 6 to 8 times EBITDA type of multiple. And frankly, because these things don't depreciate, then the maintenance capex for a load bank is almost zero. It's just growth capital. And on that basis, I mean, I get a very conservative 244p, and you look at other brokers and they're less than 200p, simply because in my view, they're valuing it the wrong way. And I could see this one track up to over £3, because what you really got to do is to adjust, because it's got such low maintenance capex going forward for its fleet, and it's got really almost like an appreciating asset there. Rather than a depreciating. I mean, most hire car companies, they have to renew their hiring equipment every 2, 3, 4 years, because there's so much capex they have to buy so they can rent it out, because it gets wear and tear, it's moving parts, particularly in the construction and house building area. But these guys don't have that. So yeah, I mean, that's when I finish
on a positive chart. That chart is the only chart I've looked at. I mean, that is in the minority, where it's not bottom right. It's almost the top right of the chart. It's nice to see.
Yeah. Well, as I said at the start of the year, what were my 2 best investments for this? They were the same as they were back in early 2021, i.e. EQLS and Northbridge, and I think both will do well. I actually think Alico is going to do well also, because that's come off and it's baby in the bathwater. But you can sell if you like. I'm certainly not. I'm just going to carry on holding, because if I didn't have such big positions in all 3 of those, then I'd be buying more, no doubt about it, at these levels.
Cool.
But I'm looking to carry on to redeploy.
Yeah. So finally, I mean, before we finish, so what I mean, do you have any cash left now, or you?
Yeah. No, I've got. Let me just run it up. I've just looking at the charts. I'll put the detail down. I mean, obviously my long-term returns. I mean, basically, since pre-pandemic, since the start of 2020, so January 2020 to now, my portfolio is up roughly around about 8-9%, etc. And it's been hit the last, well, basically this year, and it's down about 10%. But compared to AIM at 15, you know, that's reason, you know, I'm pretty much happy with that. And I've got roughly, I'm just looking at it now, mainly exposure to small cap. So out of 100%, it's got, you know, sort of like, I'd cast Amryt Pharma as a small cap, obviously. I've got 68% small caps. I've only got 5% large caps, which is, I think, is the, you know, is largely the AstraZeneca stake, and then 26% in cash. So I've still got some positions to do.
Nice to be in that position to be able to deploy that, because there's plenty of value out there. We've got a bit of time as well, I think. Well, in fact, we may have an initial bounce, you know, if we get good news on the wall. But
lots. I mean, when you look at stocks, they've just been. When you come out with just even, you know, you're not growing quite as fast as you should be, or alternatively, you're seeing cost inflation, which is obviously to do with the supply chain disruption. Shares this week and last week are down 50-60% on the day. They've been absolutely, totally taken out to the woodshed, and on that basis, there's opportunity in my view, because it's totally disproportionate to the fundamentals of the business, because the fundamentals haven't changed half as much, but the shares have just been absolutely, you know, hit really hard. And you know, I will stay, you know, hopefully, you know, disciplined, and you know, look for technology, software, and healthcare. And yeah, we have a different view on what type of risk, but that's good, because that's what people need to do.
Yeah, no, I mean, everyone has to find their own strategy, don't they? That's the thing. I mean, you know, when you first start off, you adopt other people's or parts of other people's strategy, like, and I think, and then you start to, you know, find your own way, I think. And that's, you've got to be comfortable with what you're doing, haven't you? And that's it, you know. Like I said, it comes down to the old football team. The 11 players on the pitch, they can be all world class, completely different games they play. So marvelous stuff. Cheers for that, Paul. Speak in a fortnight.